Welcome to the Big Picture Retirement Show, where you'll learn what it really takes to have a successful retirement. With over 20 years of experience, your host, Rick Rivera of Safeguard Investment Advisory Group, has seen it all and is here to help you achieve your retirement dreams. This is the Big Picture Retirement Show.
Welcome into the Big Picture Retirement Show with Rick Rivera. Rick is a partner at Safeguard Investment Advisory Group. Rick, Eddie Soda, Reed Abedin, they all have over 20 years of experience in the financial industry, and they're really here to help you figure out where you are on your road to retirement. Can I retire? Well, when can I retire? Do I have enough? Are we going to be okay? Will our money last? You can always call them with those kind of questions, because that's what the Safeguard Investment Advisory Group is all about, is helping you figure out where you are. And then if you become a client, they put the plan together for you, and there you go. You got some clarity into that retirement picture. 800-700-1980 is the number, 800-700-1980. There are about 6 offices across California that Safeguard has. If you'd like to learn more about that, it's safeguardinvestment.com, safeguardinvestment.com. I'm Mark Elliott. Glad you're with us today. We're going to touch on Social Security in our next segment, but thought it would be good just to start. A lot of people kind of freak out when the markets get bumpy. We know that Trump's tariff talks have made the markets bumpy. Market likes certainty. He put a 90-day pause on tariffs. Markets went up for a little bit, but then they go down again. Where are you and where are your clients? Are you getting calls that people are nervous about what's going on with their portfolios?
Actually, no. Well, let me take that back. There might have been, 1 or 2 calls here and there, but for the most part, most of our clients are calling us for, hey, how do we leverage these down markets in our favor? And that's what's so unique about our clientele, is that because of the relationship that we have with our clients, we have a plan. And when we structure their plans, we know there's going to be market volatility. There's always been market volatility, throughout the years. There's always been cycles, and our market has experienced all kinds of different things. So what we do is we already have in place strategies that when the market cycles and it goes down or it's volatile for whatever reason, something throws at it, we're like, okay, what do we do to leverage these things in our favor? Can we reallocate to buy more shares at these cheaper prices? Does it make more sense for this particular client in this situation to actually start doing more Roth conversions? Because if the Roth conversions are done strategically, now that the prices are depressed, we can actually get more shares over to their Roth in a much more tax efficient manner. And then all the interest and dividends on top of it are being reinvested onto that side of the equation. And then we have clients that are actually pulling money out of other areas, again, to buy more shares at cheaper prices, because we know that the market's going to come back. And, out of any 10-year cycle, we're always going to have at least 2-3 years in a 10-year cycle where the market's down. So during those times, rather than us just, sitting there and saying, oh, well, we know the market's going to come back. Yeah, we know it's going to come back, just when. But during that period of time, while we have opportunity, why not leverage it in our favor? Because here's the other thing I want to point out, Mark. Every single time the market goes down, I don't care if we were talking about 9/11 or COVID, that 1 month where it dropped 30%, or 08, whatever time period you want. I can't tell you how many times, 6 months or a year later, people are always, oh, well, you know what? If I would have known, I would have invested more. If I only knew, I would have bought more. If I only knew, I would have done more Roth conversions. If I only knew, I would have done this or that, or used some tax cost harvesting strategies to offset some of the gains I had in these other areas in order to be able to now reinvest my portfolio going forward into a more diversified approach. So for 99% of our clients, we're actually saying, oh, this is good news. We can leverage this in your favor. It's time to go to work, roll up our sleeves and go to work.
Yeah, so it really is interesting. You mentioned the fact that when the markets go down, it's even a better time to move some of that IRA or 401k money that's in the traditional side into the Roth side. It makes sense for a lot of people. It doesn't make sense for everybody, though. How do you determine, well, this is a good idea, this is not a good idea?
Oh, you know what? I'm glad you asked that question, because what we do is before we do the Roth conversions, we sit down with the clients and we look at their taxes, we look at their income, and we actually review what their Social Security income is coming in. And then what we do is we actually run a mock tax return and figure out where is the sweet spot for them. So we're just not doing things willy-nilly. What we do is we look at their actual taxes, and then we have a CPA that we work with directly. So if we have to run a mock tax return, we can, and say, okay, here is a sweet spot for you where we can convert and keep you within a certain marginal tax bracket. So that way we're paying the taxes wholesale instead of retail on these conversions. And then when these things when the market does come back and it bounces back up, it's all on your Roth side of the equation. The other thing that we got to take into consideration too is that when we're looking at these numbers, is making sure that they don't fall into IRMA where once your income goes over a certain level, now your healthcare premiums go up. And unfortunately, there was a gentleman I met not too long ago that he kind of did this thing on his own. And this is where it's important you make sure before you do any of these strategies that we talk about on the radio show, make sure you sit down with a qualified advisor that knows what they're doing and specializes in this area. Because I just talked to a gentleman not too long ago, and I can give you many other examples where he literally told me he did the conversion on his own. He didn't consult anybody. His challenge is that he converted too much. It threw him into a much higher tax bracket than he wanted to be in. But the other thing too is that he didn't even know what IRMA was. And now his healthcare premiums, now he knows what IRMA is, and now his healthcare premiums are going to be much higher over the next year because of the way he did the conversions. So don't try to penny pinch, reaching over the dollars to pick up the pennies. You can come in and talk to us directly, and we'll give you a second opinion. It doesn't cost you anything to get a second opinion. But, if you have an advisor that can help you and guide you so that way you can make sure you're doing things efficiently and don't get blindsided by things, that is so important. And make sure, again, that's why we run mock tax returns and show people in black and white exactly what it's going to look like in their situation. So again, they don't get caught by surprise.
Yeah, I think it's one of the great opportunities you have. It's why Rick and the team at Safeguard Investment Advisor Group do the show, is to give you some insight. And you have the opportunity, if you have questions, you're like, well, I've been thinking about doing some Roth conversions. I don't know if I should. Like the one gentleman just did it, and then it caused him some issues with Medicare Part B. The premiums go up because of a 2-year look back. There's a lot of issues in this, and it's tough, I think, to do it on your own, unless you're like Rick and you've worked in this field for over 20 years. A little bit easier. I would have no clue. So I need Rick's advice. That's what maybe a lot of you would. It couldn't hurt to get a second opinion. Here's what I'm thinking. Do you think I should do it? Should I not do it? And if I do it, how should I do it? Because that's all the kind of things that Rick and the team will think about. It's 800-700-1980. Again, no cost for this whatsoever. It's a great opportunity for you to get some clarity into your situation. Should you be rebalancing your portfolio? Should you adjust how you're investing right now? Everything's up in the air right now. The idea is let's find out your situation, what you should be doing. Rick and the team are here to help. 800-700-1980. When you think about that, like rebalancing a portfolio, after we had like Amazon and Facebook and NVIDIA and all those going crazy for a while, they were, I think, 18, 20, 30% of the market at one point. I mean, it's pretty crazy how just like 7 investments were taking the majority of the market's upside. Is this a time to rebalance our portfolio?
I would say, okay, so what's going to happen is this. If you're rebalancing, I would do it in a way, obviously it's got to meet your parameters, but in general, I think it's a great time to rebalance because what's happening is this. Let's say you have, and I'm talking generally, folks, so always make sure you consult an advisor because everybody's situation is different. But as far as rebalancing, yeah, it's a great time because here's the thing. Let's say, I'm just going to make up a number. Let's just say you have 70% in equities and 30% in bonds, fixed income. And now the market drops. And now let's say your portfolio drops to 60-40 because the equities went down in value. Well, hey, why not? We know the market's going to rebound. Why not take, as long as we're buying good fundamental positions, I'm going to put a caveat to that. Why don't we sell some of the fixed income and buy more equities at the cheaper prices while we can get clearance sales and bargain basement deals, and then we rebalance that portfolio back to 70-30. Now, on the other side of the token, it works the same way too. Because let's say, for example, the market takes off and now my portfolio is 80-20. Hey, a gain is not a gain until it's realized. So maybe we shave some of the winnings off the table and put it back into the fixed income, and then we rebalance back to 70-30. So now we're really strategizing. So it's very important that we look at this on a regular basis. For our clients, we do it automatically quarterly. And if we need to do it more than that, great. There are times where let's maybe, we're looking at it on a quarterly basis, but based on what the market's doing, we don't necessarily need to reallocate just based on what's going on. But that is something that we are looking at on a quarterly basis. So again, we can leverage things in clients' favors as much as possible. We're just not sitting there just waiting for things to happen. And unfortunately, some of the advisors out there, some of the things that we've been hearing from clients is that, they call up their broker and they're just like, oh, we'll just hang in there, it'll come back. And they're really not doing anything. No, there's things that we can do to leverage. And that's what's so important.
Here's something that Rick offers every week on this program. Again, the number is 800-700-1980, but it's this. Come in and sit down with Rick and the team at Safeguard, 45-minute chat, maybe an hour, whatever. But it's about you, so that's a good thing, right? Let's figure out where you are. But Rick says do that, and he will guarantee you that he will give you two ideas that will enhance whatever it is you are currently doing. Certainly when markets get bumpy, you're confused about the portfolio. Should I do this? Should I do that? Remember, we talked a few weeks ago about if you put $10,000 in the S&P 500 in 1980, in 2022, 42 years later, it was worth $1.1 million. But in that 42-year span, if you missed the 5 best trading days in a 42-year span, that number was not 1.1 million, it was now 670,000. That's crazy. So timing the market's impossible, but having a strategy is possible. Talk with Rick and the team. Again, it's 800-700-1980. Back with more of the Big Picture Retirement Show with Rick Rivera of Safeguard Investment Advisor Group right after this.
You're listening to the Big Picture Retirement Show with Rick Rivera. For more information about Rick and the Safeguard Investment Advisory Group team, go to safeguardinvestment.com. While you're there, you can also download educational retirement guides and sign up for an upcoming seminar. That's safeguardinvestment.com. Now, back to the podcast.
Welcome back to the Big Picture Retirement Show with Rick Rivera. I'm Mark Elliott. Rick is a partner at Safeguard Investment Advisor Group. The website, safeguardinvestment.com, to learn more, find out about upcoming events, find out more about Rick, Eddie, Reed, the team, safeguardinvestment.com. Call them if you have questions. 800-700-1980, 800-700-1980. So, we were talking about the markets and tariffs and portfolios and rebalancing and all those things, Roth conversions. There's so much going on. One of the things that I think for me at 65, Rick, I haven't started Social Security yet. I might start it next September of 2026 because I'd be 66 in 10 months, born in 1959. That's my full retirement age. But when things get bumpy, since most, my grandparents had pensions and Social Security, I don't have a pension. So Social Security is the only kind of guaranteed income I would have whenever I decide to start it. Is Social Security, when things get bumpy, maybe an opportunity to not maybe pull as much out of your market investments? I mean, Social Security can be a really big deal, can't it?
Well, yeah, it's structuring the income. Quite frankly, I have this conversation with people all the time where when they're retiring, they're deciding, hey, should I pull Social Security early, or maybe should I pull it at a later date so I can get a higher amount of, benefit? And sometimes, like, I just had a conversation with a client actually yesterday where the gentleman was like, hey, listen, you know what? If I wait 2 years, I'll get it was actually an extra $450 a month more on Social Security. So the scenario there is, well, if I have to now make up the income out of your IRA, over those next 2 years, it worked out. We did the numbers in his particular case. We would have to draw a little over 68,000, almost 69,000 out of the investments in order to cover him for those 2 years so he can get an extra $450 a month in Social Security. Now, the other thing that I had to, point out to him is like, okay, well, in order to make up that shortfall, in order to claw that 69,000 back that he took out of his own investments, it was going to take him around 13, 14 years or so. It was roughly the math on that. But here's the thing that he didn't take into consideration. If I have a choice of pulling that 69,000 out of Social Security over those 2 years of period of time versus pulling it out of my IRA, those two things are taxed differently. And a lot of people don't realize that, where if I pull the money out of the IRA, 100% of that money gets reportable on the return. Where with Social Security, worst case scenario, 85% of it is reportable on the return, and the other 15% is tax-free. So in that particular case, does it make more, if I'm going to take the money from one bucket versus another, would it make more sense for me to use the Social Security that's going to be taxed much more efficiently and let my own investments continue to grow and compound over the next 2 years? And then if I need an extra $400 or $450 a month at that point, well, now I even have more money in my bucket that I can use to create that extra income if I need it. And maybe I don't need, and I don't. So these are all kind of like parameters that we look at. We look at the pros, the cons. And again, if we have to run a mock tax return for a client, showing them, hey, if you do it this way, here's what things look like. If you do it this way, here's what it's going to look like. And again, everything has pros and cons, but we can do it based on your particular situation. And at least if you're making a decision, you're making an informed decision rather than just willy-nilly. Oh, well, you know what? I get an extra 450, but I'm not taking taxes into consideration and a whole other a variety of scenarios, into the process.
Yeah, and everybody's situation is unique. It's one of the things that I think, and I'm 65, but I have a lot of friends that are already retired. They were school teachers, or they worked for somewhere where they actually had a pension. So they all retired right between 58 and 62. So every single one of them basically started Social Security at 62. And I'm saying, did you look into that at all? No, it just makes sense. I'm retired. I'm going to take it. People tend to look at Social Security, I think, in a vacuum. And if you think of a married couple and they're going to be retired 25 or 30 years, that's $1 million decision. It doesn't mean you should wait till 70. Doesn't mean you're wrong if you take it at 62. But it's about doing the math where you can really help them figure out, because it's about their own situation. Social Security is a big part of the income plan, isn't it?
Yeah, and the other thing too, if I can add another layer to this cake, is let's say technically they don't need Social Security. Let's say they don't need to pull money out of the investments, and they don't need Social Security. So they're like, hey, listen, I don't necessarily need it. My pensions are good enough, so I'm just going to wait. Well, here's the other thing too, is that we look at and we say, okay, well, listen, since you don't necessarily need it, maybe if we took it earlier, since you don't need it, maybe we leverage the Social Security to pay the taxes on Roth conversions. And if we're leveraging it to pay the taxes on your Roth conversions, now we can convert more money over faster. And we're leveraging the Social Security, not your own money, to pay the taxes. So how does that help us down the road? That not only are we moving money into a tax-free bucket, but down the road, if we do need incremental raises, now we have a bucket that we can use tax-free to create those incremental raises that you might need. And then, of course, if one spouse predeceases the other and we lose a Social Security check and we have to make a shortfall, make up that shortfall in income, now I have a huge tax-free bucket to work with in order to create that shortfall in income for the surviving spouse. Or maybe they need long-term care, or maybe they need a care in the home where medical insurance doesn't cover, and we have to create some extra income to cover, somebody to come in and do some of the heavy lifting that they can't do anymore. I can do it in a much more tax efficient manner. So these are all things like, thinking outside the box. And a lot of the stuff that we've come up with is really, again, just being in this industry for almost 30 years where we've learned from our clients' experiences over the years, and we've been able to implement their experiences into our practice. So, there's so many different directions we can go. And how is one going to know what directions are even available to them unless they take the time to sit down with an advisor, again, that specializes in this area? So I suggest that if nobody's ever talked to you about these different strategies, give us a call, toll free, 800-700-1980, and we'll offer you an hour free consultation. Again, leave your checkbooks and all that behind. At least get a second opinion and see what the possibilities are, rather than, again, down the road, finding out, oh my gosh, I wish I'd known about this 5 years ago or 10 years ago, or getting blindsided because you did something willy-nilly and now you're paying too much in taxes, or maybe, your health insurance premiums go up, or you're losing part of your Social Security. So again, it's real important to get that advice.
Yeah, 800-700-1980. For a lot of us, it'd probably be a first opinion. Never really sat down with anybody, just been to work, raised a family. Now I'm thinking about retiring. I wonder when I should do this. Roth conversion, Social Security. There's so many options that Rick and the team can walk you through. Because the other part of that, it'd be great if Social Security is just to fund money, right? That would be phenomenal. If you got to that point where I don't really need that $2,000, $3,000, $4,000 a month, we can just go play with it. That would be great. But for some, it's maybe an opportunity to maybe, while they're still working, maybe once they hit the full retirement age where there's no give a dollar back for every 2 you're getting for Social Security, where you get it all, where you just maybe pay off some credit cards and stuff and get to that point of no debt at 70 because you use Social Security in that way.
Oh, absolutely. Yeah. That's it. Yeah, actually, I'm glad you brought that up because we've had scenarios. And again, it's coincidentally everything you're bringing up. I had just recently, I had one gentleman that, he actually has a 108,000 student loan because he, got one of those parent loans for his kid. He's in retirement. He's got to pay off this student loan. Or I run into clients that have a bunch of credit card debt, and does it make more sense to use the Social Security to pay off that 18% credit card debt? Yeah, I think it just may make worth your while to do that over the long haul. But again, rather than just saying, yeah, let's do it, what we do is we crunch numbers for you and say, here's what it looks like if you take Social Security early and pay off this debt. Here's what it's going to look like for you over the long haul. Or here's what it's going to look like if you decide, hey, let's delay taking Social Security and we're going to keep this debt and pay it off the way you're doing it now. Here's what that's going to look like over the long haul. So again, you have something to compare. You have something to sink your teeth into, to digest. So then that way you can make a more educated decision as to what's best for you. So if you'd like, feel free to give us a call right now. Dial 800-700-1980. And I'll offer you a 1-hour free consultation with me personally. Come, you leave your checkbooks and all that behind. As long as you give me at least an hour, I promise you I'll give you at least 2 ideas that'll enhance whatever it is that you're doing, and it won't cost you anything. And as an option B, if you feel like, hey, you know what, but I'm sure if I really want to come in and meet somebody face to face, if you'd like to know what we're about first, also, you can dial that 800 number and maybe sign up for one of our workshop seminars. They're absolutely free, no obligation at those seminars. And then maybe that's an opportunity for you to get a chance to just meet us and meet the team. And then if you decide you'd like a consultation where you meet us one-on-one, we can do that as well. So again, 800-700-1980.
Firm offers insurance services. Safeguard Investment Advisory Group, LLC is a registered investment advisory firm. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Safeguard Investment Advisory Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Safeguard Investment Advisory Group, LLC.